What is up, YouTube? This is the working investor. Sentiment on the street is gone kind of like nay-nay pretty recently. Everyone's all panicky and frantic and frazzled and gedazzled because the market is starting to go down and people just start going nuts. So I have a joke for you guys. What stock do people watch the most? Netflix, because they're watching it all the time. Anyways, if you look at the big picture over the past, 95 years, 94 years, the market has been up 78% of the time. The market is only down, different studies, 22% of the time. Oh, you could Google it. There's lots of, but basically the point is we're so used to an up market, we're not used to down markets. And there's so many opportunities when it comes to down markets. And the way we look at things when the market is up is not the same way we look at things when the market is down. Yes, I'm also down with you guys pretty bad, like 10% in the past week. I'm probably down further than the NASDAQ, S&P, because I think the NASDAQ was down 6%, S&P down 4%. So I'm glad you guys are not following me and copying me, because then you guys would be out underperforming the market the past week. So yeah, do not follow me. Do not follow anybody on YouTube. Just use your own judgment. Speak to who you have to speak to. Let's talk about diversification. So some people say that if you diversify, there's safety, right? Because if you have a basket of funds and one company goes sour, one apple's sour in the basket, you still got the rest of that basket to keep you up. But then, when a whole market overall is going down, there's nowhere really to hide because, everything goes down. If the ship goes down, the Titanic goes down, it's a large ship, but no matter where you're hiding in the Titanic, whichever room you're in, you're going down. Maybe you're on a higher floor and you're going down, later, but you're going down. So when the whole ship is going down, you're going down. The thing is, it's so interesting how a lot of what we do in the market is what the market does. And then the second part of the equation is what you do, what you personally do. Look in the mirror and what you personally do as an investor. When it comes to diversification, there is diversification of underlying. There's stocks, there's bonds, there's treasuries, there's cash, precious metals, crypto, commodities, real estate. There's also diversifying in yourself, like upping your career, because obviously, we're only limited with the time we have. And basically, we are an equation of our innate value that we provide to our employer multiplied by time. So the more value you make yourself, the more your hour, rate per hour increases, and then times yourself. But then even greater, the more you educate yourself and learn and connect with people, the more you're able to have new ideas and create a business. Okay, I digress. That's a different video in itself. But there's also time, the diversification of time. Like in options, you could do different expiration dates, right? There's also something called long versus short, right? When you buy stuff, most of us just buy assets, buy gold, buy silver, buy stocks. When you buy something, you're actually long the position. That means you are trying to make money if the asset goes up. But if it goes down, you lose money. But you can play the opposite. You can also short the market as well. You could short certain underlyings. I'm not telling you to do so, but if you see an overall trend, there is some opportunity there, right? There is some opportunity to long versus short the market. Some strategies are very into longing the market, and some strategies are shorting the market. There are deltas. There's, in option land, there's how far out, like how big your risk is. Like, maybe you could change your risk. There's something called beta weighted deltas. You got to look it up, but there's talk about, you factor in the volatility with your deltas. But I want to get out of and then I promise you we'll get out of the option jargon here. And then there's buying insurance. Like you could buy protective puts. If you have a lot of stock and you could buy a protective put, but it's best to buy it before it happens, because once the market's going down, everybody panics and everybody wants to buy these protective puts, and then they go up in price and premium. So there's these protective puts that people could buy as we go along. It's like insurance if you're close to retirement and you don't want to lose more than a certain amount. Something that a lot of people overlook, a lot of people overlook, and it just drives me crazy, is looking at redundant assets. Like somebody would buy, let's say, the Magnificent Seven, and then they buy the S&P 500, which we're all guilty of, right? But it's in the S&P 500, right? So if the S&P 500 goes down, your Magnificent Seven is part of it. It's redundant. There's part of it. There's exposure in both, right? Or you buy 5 different ETFs, and they all kind of, if you look, there used to be this thing called, I'm not sure they still have it. TD Ameritrade used to have it. It was called the Portfolio X-ray, where you put in multiple different ETFs, and it tells you where there's a lot of overlap in similar holdings. Like you'd be shocked to see that, maybe you have an overexposure to Walmart because every single ETF you have has Walmart. So it's redundant in every single portfolio. So when a certain sector goes down and all your holdings go down because you're holding the same thing here and there. You think you're diversified because you're holding 10, 20, 30 different ETFs, but you're not, because they're all holding a lot of the same stuff. So you have to be careful when you have redundant assets. And I'm guilty of it itself. Some of the assets that I have, like I have option products, as you know, some of them do daily covered calls, synthetic covered calls on futures, which are kind of all similar. And then there's ones that do call credit spreads. And I have synthetic covered puts. So there are some differences here and there. And also cutting the fat. It's so interesting how when the market is up and up, we tend to buy stuff. Oh, we just you go to the store and you're about to go to checkout, and they have these like little tempting items, and you're just like, yeah, I'll just put it in my cart. Why not? It's only $2-3. So we can't just snack on these, we don't think too much about it and just buy a couple stocks of this and that or whatever. And all of a sudden, when the market goes down, we have a hard look at our portfolio. I'm like, why the heck did I buy this nonsense, coin, or nonsense stock, or hype stock or penny stock? So it's so funny how we tend to cut the fat when the market goes down. But it's like the worst. Sometimes it's kind of stupid because it's better to cut the fat and have a very high scrutiny of your account when everything is good. So when you cut the fat, you're not losing money. You're kind of just like, you have your buying power back, and you can go ahead and buy something more that's correlated and aligned with your goals. But unfortunately, it's funny how we do it. I just wanted to mention, it's funny how we all scrutinize and look double down. They say, there's a saying that, in the short tide, a lot of us could be in the water, the beach, and some of us could be naked or fat, whatever. Not fat shaming anybody. But then when the tide goes down, you could see who's swimming naked. So a lot of times you have these low quality companies and low quality holdings and assets, and everybody looks like a genius. You're a genius in the bull market. Like, you could buy anything. You're just like, wow, you're so smart. But when the things go down, then you're then you see who's bottoming them out, and so everything gets exposed. Everything comes to light. A lot of people say you should stay the course. So if you have wise assets that you are happy with, and it's good to play this mental exercise when the market is up, to think to yourself, if the market were to go down, would I still want to buy this asset? Would I double down on it? If the answer is I would not double down on it, then gue it shouldn't be something that you should be getting into when the market's up, because if your gestalt is not very strong in a certain underlying, and you didn't do enough research, you don't understand it enough, then as soon as the market goes down, you'll just sell for a loss, and maybe that was not the right thing to do. And then later on, you're like, oh my God, why did I sell it? Because you didn't understand it well enough. That's why it's very important to understand very, very carefully what you're buying. It'll help you stay the course. Like I said, there's what the market does, and then there's what you do. There's another side of the equation of what causes a a loss in your account. And then people forget about the tax benefits. Like if you're, let's say you've done some, introspection and you're looking through all your portfolio and you find out you want to rebalance, you want to rechange positions. There is a little bit of a silver lining, and it's not really, you don't want to take a loss, take the L, but if you find, let's say, Pepsi and Coca-Cola, and you're like, oh, I hate Coca-Cola, but I like Pepsi, and they're very correlated, but they're different. You could sell out of one asset and buy the other, and then you have like a taxable, you have a net negative on your account that can counteract some gains or give you some tax benefit. So there's some tax benefits there. And then there's buying opportunities, like things are on sale. Things are on sale. I think we're just all jolted because we're not used to it, because 78% of the time the market is up. So we are not used to, when the market goes down. It's crazy because people say like, oh my God, if there was a crazy sale, would you not buy goods and services? Would you not take advantage? And it sounds crazy that in stocks we do the opposite. We fear. But the truth is, I don't know if that's a good analogy, because when you're buying, as a consumer, when you're buying goods and services, you're buying goods and services. You know what you're doing. But when you go into investments, in our minds, we think to ourselves like, this is not something that's going to give me pleasure today, but it's something that's the purpose of it is to provide growth and provide increase and move. But if it's going in the wrong direction, it's kind of scary. So I don't know if it's a good analogy, because when you go to a store and you buy goods and services, and now you have more goods and services, it's a very clear way of seeing that you have a net positive. But when you buy an investment vehicle and you see it's going in the wrong direction, the momentum's going against you, you feel kind of silly, because you feel like it's eroding your investment. Like if you bought a car and the car is starting to not go forward, I don't know if that's a good analogy, but if you buy a product and the product is not as expected, it kind of shocks you. So I'm not sure if it's a perfect analogy. It's somewhat of an analogy, but in our mindset, in our psyche, it definitely messes us up. That's why foresight and research before. Take your time when you buy investments. Take your time, because it's a lot of there's a lot of articles out there that say that the average consumer probably spends more time looking up the specs of your new gadget, your new smartphone, than you did looking up a stock. You spend more time looking up liabilities than you look up asset. Like you're buying a car, you're going to look. A lot of people spend months researching all the features and how to buy them the best, and you don't think twice before. Hey, I heard this really cool meme stock out there. Let me go grab some. So we should at least spend, the same amount of time that we would look up consumer good than looking up stocks. Just my 2 cents. I hope you guys are doing well. Take it easy. And the march keeps drudging on. All the best.